Hello and welcome to Prosperity by the Pint, episode 65. I'm your host, Brice Carter, certified financial planner, chartered financial consultant, certified investment management analyst, and self-proclaimed millennial money expert. This is a podcast where we talk about money, investing, business, and life success, all while having a cold beer. This week's episode is one of a two-parter about the case for international investing. And more importantly than the topic is the beer at hand. So the beer of the week is from Good City Brewing in Milwaukee, Wisconsin. It's called Risk. How fitting. All investment involves risk, as the disclosure at the end of the podcast indicates. And it's an IPA, Risk IPA, 6.5% alcohol. I have not had this before. My producer, Allie, picked this up for me while she was in Milwaukee on vacation. So cheers. Let's give it a try. Well, that is lovely. Good job, Allie. She's very proud of herself. I'm very proud of you. So the case for international investing. Now, there has been a lot of, basically, let me summarize it in this. Every investment manager and financial planner basically out there believes, with a handful of exceptions, that you should invest your portfolio in a diversified fashion, and ideally diversification means globally, which means you own both U.S. stocks and international stocks. So that logic is rooted in the fact that different countries and different economic situations perform differently at different times, right? And so there's no real debate over the evidence. The only debate comes in is that over time, the world has become more global, where U.S. large companies do a lot of business internationally, and international large companies do a lot of business in the U.S. And so therefore, there's not as much of a diversification benefit as there maybe once was. And I would argue that may be true to a certain degree. However, the large companies, since we have really good market data, have always been, for the most part, been global companies, right? So you're looking from the 70s and 80s on, you're looking at a lot of global companies. Now, that may have expanded, but that doesn't negate the need for international diversification. Now, because pretty much all money managers, investment academics, economists believe that global, international, diversified portfolio is the way to go, most of them have international investments in their portfolios, or the portfolios that they recommend, and therefore have kicked themselves in the teeth repeatedly, or in the mouth, or put their foot in their mouth repeatedly over the last 10 years. And that is because the last 10 years, the U.S. has outperformed dramatically. It's the largest 10-year time frame in which the U.S. has outperformed since 1989 to 1999. And it's outperformed by about 6% a year. I mean, in all reality, the performance the only thing that really comes close is 89 to 99, but also post-World War II, 1945 to 1949, when the rest of the world was essentially destroyed, right, by World War II taking place in their backyards, and the U.S. had a chance to basically skip ahead, right? And our economy grew at a rate in which other economies didn't. So there's been 3 periods of time in which the U.S. has just dramatically outperformed, and that has been 2009 to 2019, 1989 to 1999, and 1945 to 1950. Now, the 1945 to 1949, 50 range is pretty self-explanatory. We got World War II, the rest of the world was destroyed. During 89 to 99, the market crashed, essentially, and the market overall was doing really, it crashed in 87, but then internationally, you didn't get as much as the tech bubble crashing as you did really with the U.S. market. So internationally, they're less focused on tech, therefore they weren't impacted by that. But what I'm leading up to is not just to make the case for international, but to, particularly in this first episode, is kind of explain why the U.S. has outperformed over the last 10 years and what that means for markets. So what Morningstar did, Morningstar is a research firm, they're extremely well known, is they did a series of different studies, and they looked at different markets. So a lot of stuff I'm going to be saying today is going to be coming from some of the studies that they did. They tested 29 different countries using 4 different valuation methods. And what they did was say stocks are either fairly priced, they're moderately, they're expensive or they're underpriced, right? And when they ran all these different countries and said this country is either overpriced, underpriced, or fairly priced, in every scenario, basically, underpriced ended up doing better over a period of time. Now, for the last 10 years, that logic has been completely thrown out. The U.S. has outperformed even against cheap countries where their valuation was cheap compared to the amount of earnings that company had inside of that country. And so valuations have been thrown out the window for the last 10 years. And I want to hammer down into why. And so if you look at the performance of the S&P 500, which is the 500 largest stocks in the U.S., and compare it to international, I mean, you're looking at like 2.5 times better returns U.S. versus international over the last 10 years. And that really comes down to about 6 companies: Facebook, Apple, Amazon, Alphabet, which is Google, and Microsoft. So Facebook, Apple, Amazon, Alphabet, Microsoft, and Netflix. Netflix is the sixth company. Those companies, if you strip them out of the S&P 500, the performance is not identical, but it's extremely close. We're not talking about 6% a year. We're talking about a fraction of a percent a year over the last 10 years. These 6 companies have grown at such a rate that they are responsible for almost all the outperformance of the other of the U.S. market. And granted, in the large S&P 500 index, there's 494 other companies. And so I wish I could put the chart up on the screen, and maybe that's a capability we'll get the podcast, but most people listen over the voice only. So let me put it to you this way. You put a chart of the S&P 500, and you put a chart of the international markets. We call it EFI, East Asia Far East, East Asia Far East, EFI investments, over the last 10 years, and the S&P 500 just kicks the shit out of it. Then you pull out 6 companies, and they're right next to each other. What we've actually seen is that over the last 10 years, these 6 companies accounted for something around 4% of the S&P 500, and now they account for about 24% of the S&P 500 as far as the value. The growth is just unbelievable. So here's the exact statistic. These companies went from 4.74% of the S&P 500 in 2009. Now, those 5 companies are 20.54% of the S&P 500. Now, beginning in 2010, they were 6% of the S&P 500 earnings, and now they're about 11% of the earnings. So the earnings doubled, but the value quadrupled. So let me say that again. For these 6 companies, the earnings doubled. They made twice as much money, but their value quadrupled. What essentially happened is these companies went from, pretty medium, large size companies to just mega cap. These are the biggest companies out there. We're talking $1 trillion market caps, and their specific niche, essentially being technology and communication services, is what has driven the market over the last 10 years. So the other reason, now I'm going to get into a little more specifics after I sip this beer a little bit more. So internationally, you have a breakdown of, it's domestic and international, different sectors of the market, okay? So you have energy, you have infrastructure, you have industrial companies, you have financial companies, you have technology companies, you have communication services companies, you have commodities companies, you have real estate, et cetera, et cetera. In international markets, it's primarily dominated by financial and energy companies. In the U.S., our market is primarily dominated by tech companies and communication services. Those are both underweight companies in international indexes. And so what you see is that over the last 10 years, technology companies and communication services companies have outperformed the rest of the market dramatically. So what ends up happening is the international market underperforms simply by the fact that they don't have as many tech companies, or simply that they don't have as many international or communication services companies. And we also see that the fact that they have a lot of financials, because of low interest rates, financial companies have struggled. Banks have struggled over the last 10 years. And so what I'm getting at is that over the last 10 years, there has started to be a mindset shift that maybe you don't need to invest internationally. I mean, the U.S. we have some of the biggest, we have some of the best companies. We have, technology companies. Tech is the way of the future, and we've outperformed dramatically, and it's a global economy. And I'm here to tell you that although the U.S. is dominated, it's been a very small subset of the U.S. that has dominated tech and communication services, specifically 6 companies. And that the likelihood of that happening going forward is extremely unlikely. Okay? So the benefits of international diversification, in my mind, outweigh the downsides to it. Because the downside is you might end up underperforming for a period of time. But when risk happens big time, right? So you look at a scenario like right now, what they're experiencing with the coronavirus is the curve started to flatten and drop down in the U.S., and now it has started to rise, and it's continued to stay flat or decline internationally. So that might be a catalyst for international outperforming, as maybe their economy doesn't shut down and ours does have to again. I don't know. You look at a scenario where currency matters and political strife matters. So the U.S. one of the reasons and catalysts for the U.S. outperformance in the last couple of years has been stock buybacks, and those were triggered by the Trump tax cuts in 2017. Now, I'm not against stock buybacks. I wish companies would use their money for other things, but it has driven outperformance. Stock buybacks aren't popular international, and we're in a political environment now where they're extremely unpopular, so that's likely not going to continue going forward. So the point of this is all to say that the U.S. has outperformed internationally. There's been a couple of reasons why, and I don't think that it's likely that that will happen going forward. So to examine that just a little bit further, so the drivers of long-term stock returns in both international and U.S. markets of very long term, since basically the 1900s, has been inflation accounts for about 2% of returns. Yield and stock buybacks, so dividends and stock buybacks, is about 5%. And then growth is about 1.9%. So that's companies reinvesting their cash flow and building their businesses, building their earnings, just growing the business. So 2% is inflation, 5% is dividend and stock buybacks, and 2% is good old-fashioned genuine growth for a long-term average return of stocks of about 9%. Now, since 2009, U.S. stocks have averaged 13.5%. Inflation was 1.6, so a little less than typical. Yield was 4.4, a little less than typical. Growth was 3%, which is better than usual, but 3.8% of it was a change in valuation, meaning stocks got more expensive in relationship to their earnings. Now, what that means is that in order to justify that increase in valuation, they have to grow exponentially faster over the next 10 years than they even did over the previous 10. So if we're looking at a situation in the market and the economy in these countries have to grow at a faster rate than they already have, which is an extremely fast rate to begin with, I'm saying it's not very likely. And Morningstar's got some statistics on this. So right now, looking at the market statistics, they are saying that there is less than a 12% chance that the market can keep up with the valuation growth expectations. So let's see if I can reword this in a way that makes a little bit more sense. Right now, the market is priced in 7.9% growth expectation. There has only been 2 instances of growth above 8% of 7.9 is basically growth in the period in which they collected. So since World War I. And basically, one happens in World War I. Right after World War I, the economy blew up. And so, I mean, this is what they're saying, is the U.S. is pricing in a 7.9% growth rate for the next 10 years. And that happens less than 12% of the time. So I think it's very unlikely that the U.S. stock market outperforms like what it has over the previous. And so our argument would be that international markets present a much better value at this particular time. Not to mention, it helps you diversify your risk of political strife, change in policy, overvaluation, currency exchange rates, coronavirus, and other risks of that nature. So I'm going to dive in more specifically into why international seems attractive in the next episode. But to summarize, U.S. stocks have done better. They're really pretty expensive. In order for them to continue to do better, they have to grow at a really, really high rate, which is not seeming that it's going to be likely in the sense that it very rarely happens, especially when it has happened. It's been off the back of something bad, like a world war. So it could happen. It's just going to stuff's got to get a lot worse before it can get better, right? So that's going to do it for this week's episode of Prosperity by the Pine. I hope you enjoyed. Don't forget to subscribe, iTunes, YouTube, Spotify, Facebook, wherever you listen, that's where we are. Cheers. The topics that I discuss in this podcast are meant to be general information and educational only. I'm not giving you specific advice because I don't know you personally. In order to give you specific advice, you should work with an advisor, someone that can learn your specific situation and give you advice that applies to you. If I talk about a specific security, please keep in mind I'm not recommending that security. And don't forget, investing involves risk. When you invest, there's always the possibility of losing capital, which is why you should consult with a qualified, licensed financial advisor prior to investing.